Hey everyone, Lance here, and in today's video, we're going to talk about the big short of 2019, Beyond Meat. Now, everybody thought this high flyer would move lower, and in fact, it did after its beautiful run up from 239 to today, just at $77. But even though the stock got crushed, the put buyers, especially the out the money put buyers, well, they lost money actually, or break even if best. And if you try to short stock, they made the cost to borrow so expensive that nobody really had the guts to pay all that. So, a couple of things to look at here. And I want to go over by the end of this video one tip how you can actually make money by shorting stock. Look down below, and this is implied volatility. Now you can see that the market makers jacked up the implied volatility in Beyond Meat, especially as it was going up, and in fact, as it was going down, especially near the earnings result. So that's common. But what they did recently, and even though the stock has fell from about $90 to $77, is they absolutely crushed volatility, implied volatility. And what that means is if you're an option buyer, your price of those options decreases because there's less demand, there's less volatility. So I want to go over here in Beyond Meat. I'll give you an example here. Let's pull up Beyond Meat and let's go to actually the Jan 80 put. So now these are in the money and they still have time, 25 days to them. Now I'm going to remove the implied volatility. We don't need that anymore. And now I'm going to overlay the puts with the stock price. So we're going to add a study. Watch this here. We'll add a study. Where are we here? Add the study. Here we go. Compare with, and we'll customize it to the option. All right. So now we still have our stock of Beyond Meat. And then this line here, let me make it white here. Easy to read. This is the price of the Jan 80 puts. So as we can see, the price of these puts with the stock at 239 was actually right about $5. And the stock today, again, $77 and change. So let's do a more recent calculation, shall we? Those puts here today, we see them right here. Perfect. $5. When the stock was right up in here around the 150 range, those puts were only about $4. So we're looking at this basically. If you're perfect, the stock is cut in half. The puts are up $1 at best, and sometimes even, up in here, they were barely up at all in value. 50% decline in the stock, and the puts are break even, up maybe 20% at best if you're perfect. So what can you do to avoid this? Well, let me show you. If you're thinking of buying puts, especially in the new year, on some darling that you think is overextended or overvalued, what you can do is buy in the money puts, a very high delta, and basically play the one-to-one with stock. So for this example, we'll look at the 100 puts. And here they are about $22, but look at this here. Let's overlay it. So we'll use the 100 puts this time, and I bet they'll be up a lot more in value. There we go. Look at this here. So here are the 100 puts. Now with the stock at about 150, we'll go back to that example. About 150, these puts were about $9.75. Today, these puts again about $22. So you would have more than doubled your money if you bought a higher delta put option. So every time you're looking at shorting stock, I personally don't like to short stock itself because it takes up too much margin. You have to borrow shares. To me, it's just a mess. Look at deep in the money puts and play that stock to the decline and have those options move with the declining stock price. Lance here. Have a happy trading day, and more importantly, take some time off away from the screens, enjoy the holidays, and I'll get back to everyone in the new year.